Once price posts a market structure shift lower, your attention as the trader moves to this specific low in price, right there. Inside that low, what we're going to be focusing on is the last down candle, because the last down candle is where the buying took place right before that little short-term rally up. Since price broke below that low at a subsequent later time, which is really there's no rule as to how long it takes before that low is violated. We just note it, and when it's broken, it's seen as a short-term support level that's given way with a bearish context behind it. So when we see that, we're seeing the evidence is that there are smart money entities behind the marketplace driving price lower. Now, at first glance, it looks like, well, this is a missed opportunity. But no, what we do is we focus on this low because that last down candle will give us a bearish level to sell into. When price drives back up into that old short-term low we just referenced, there's going to be 3 reference points that you need to be aware of. The market structure shift is seen here. We're retracing back into it right there. What 3 points are used at this moment? You have point A, point B, and point C. When price action returns to the point of A reference, the long positions taken from A to B price swing will have an opportunity to liquidate or mitigate their losses that were occurred during the price move from B to C. Now this can result in new lower price swings to C for retesting, or a significantly lower price move into a support level that's under the market price. In short, this is an opportunity to sell whatever particular market or asset class this is. As the market breaks lower, let's say you look at the chart and this is what you see here. It does not mean that you've missed an opportunity. It just means that now you have a new opportunity that's unfolding. Do the longs in here, in that short-term low to that short-term high, do they need to be mitigated? We don't know for certain, but if we do have a belief that price is going to be moving lower longer term, that there's an unrealized lower support level or sell-side liquidity that has not been tapped into yet, we could be viewing this short-term rally in here as an opportunity for a new selling opportunity. We have another market structure shift. So where's our focus? Given what was explained in the previous example, where's our focus right now as a trader? Why are we looking at a specific level, and what are we anticipating? That low right there. Inside that low, the last down candle, that's what we're going to be looking for price to reach back up into. If it does that, we can be a seller at that moment. As price drives back above it, into that low, we're watching price trade into that last down candle right before it had that short-term rally before. Right at that moment here, we're looking to go short. As price hits that last down candle in the previous short-term low. Where's your focus at this moment? We're anticipating price to move down from this point here, which is giving us a short opportunity to run the liquidity out below this short-term low here, and potentially as low as our higher time frame support level. As price hits our longer-term support level, or anticipated bullish institutional reference point, which could be an old high, it could be an old low, it could be a bullish order block, many opportunities to frame that idea, but whatever that is that forms your idea for support, this is the objective that you'd be reaching for. As price hits that level, we would be collapsing our trade and moving to the sidelines waiting for new developments. When we have this, In the marketplace, what we're seeing is the classic support broken turns resistance. Every time price moves back to an old low, actually happening is it's referred to as buyer's remorse. The buyers at the previous short-term low that saw a short-term pop in their favor, then eventually saw the market break below that low they bought at. When price gets back to that level, they're remorseful for buying it, so they bail. But on an institutional level, the smart money understands these short-term fluctuations, and they can drive price on a short-term basis higher or lower through manipulation. So if they're going to manipulate price on the short term by having large orders come in and push and bully market pricing around, they're going to want to liquidate those positions because just like anyone else, they don't want to incur losses. So this gives them the opportunity to mitigate those losses. Premium price highs are bought by less informed traders and sold by smart money. Which are you going to be grouped in? Okay, folks, we're going to look at a quick example. And I'm going to draw your attention to a liquidity void in here. And there's equilibrium of that liquidity void, body to body end, or is the open and close. And we're going to highlight that reference point here, so halfway point of this equilibrium. The idea is we broke this high back here. We're expecting continuation on the upside. Market trades higher, but it shows a breakdown in here. Okay. In here, this failure swing right there, we're going to be looking at this low. And I'm just going to draw horizontal lines in on the respective lows. And this will be a new mitigation block when we drop down into the lower time frames. Market should sell off there. It sells off, breaks this low here, so the last down candle on this move here is there. So once price trades back up, that's a sell right in here. It shoots it, just overshoots it by a little bit, but nonetheless it breaks lower right here. So now our attention is on this low. Every rally that sees lower prices needs to be mitigated right here. So if we trade back up to that low, that's a sell. Right there is a sell. We're going to be aiming for a move back below this low, ultimately down into our equilibrium of our liquidity void right here. Low comes in at 111.48, 111.48. Here's a short-term low, hits it, trades lower, trades back up into the last down candle, hits it, overshoots a little bit, but it's inside the body of the candle, which is what a mitigation block represents. Price trades down below the last down candle here, and we have another lower low here, so we can adjust that one to that low there, right there. Price hits that. Objective is going to be break below this low, sells off, goes through it, and ultimately goes down into our mean threshold of the liquidity void. So a couple different things shown in here as an overlap study on mitigation. Let's take a look at a 30-minute chart on the same price action. Here's a mean threshold of the liquidity void. Last down candle, right for the up move. Price hits it, sell it right there. This is a mitigation block. Everything that was used to drive price higher, once it's traded below here, it's underwater. They're going to want to mitigate those losses at that candle, sell short. This last down candle here is violated here. If price trades back up to it here, we can be a seller. The body's whole entire candle is used, not just the bottom, but we can be a seller down here. So it could be a short seller at 112, 62, and our stop has to be somewhere above the down candle in here. Okay, so that high on this candle comes in at 112.89, so it needs to be above that in the form of a stop. So we could be seeing just a little bit of drawdown in here, about 20 pips or so, but never getting much above this down candle. Price trades lower, violates a very convincing break down here. Last down candle, the low, trades up. Now again, notice the body of the candle is not violated. This is hallmark characteristics of a mitigation block. Price trades up into it. We are expecting prices below this low now, and then ultimately reaches down into our mean threshold of the liquidity void. Okay, let me ask you a question real quick. What do you see in this chart at major highs and lows? Now, take a moment, pause the video here. Okay, you may have noticed these old highs being violated and a significant movement away from that. And we understand this as a turtle soup or a false breakout. It's important to understand that it's probably easy for you to see these in hindsight when I pick them out on the chart, but you probably don't have that much experience seeing them come to fruition beforehand. So in other words, you don't see them forming in advance. And it's because you haven't spent enough time going through the charts, seeing how they form over and over and over again. Now, obviously, you may not have noticed these. I'm pointing them out to you here. But for some of you that have been working with my content, maybe you've seen other ones. But these two here are the two majors. Okay, so you have two major false breaks above an old high, a nice false swing above a previous high, and then a rejection and a subsequent significant price swing lower. And then we have a false break below an old low, and we have a nice significant price rally higher. But let's take a closer look now. We have a old low here that's been violated. So the sell stops below that low has been ran out. So we would expect repricing on the upside, looking for buy-side liquidity. The market trades above an old short-term high here, pairing up the buys from the previous low with buy stops they can sell to with a movement above a previous high. Each one of these is a turtle soup, the first being a turtle soup long, the second being a turtle soup sell. Down here we have an old low that's violated where sell stops have been ran out. We have an old low over here where sell stops have been ran out. We have an old high here where buy stops have been ran out. So you can see significant price swings at looking at the daily chart like this, and it gives you a great deal of prognostication. When you anticipate every time a new high or low is formed, we expect some measure of rejection. That's the first anticipatory price skill set that you should be working towards developing, because it's the hardest one to groom in your trade psychology. Some of you probably understand that higher high failure swing and lower low failure swing, or turtle soup long and turtle soup buy. Some of you probably aren't aware that there are other distribution and accumulation patterns that take place at highs and lows. So let's take a look at that now. Okay, we're going to look at a bearish run on buy side liquidity, or a turtle soup sell. Now obviously when you look at this price action here, it should be pretty obvious after studying my material. We have equal highs that's been ran out. So there's buy stops above those equal highs in there that have been ran out here. We would reasonably expect to see what form? A sweep through and a potential rejection and trade lower. And that's what you would see here as an example. Now, some of you probably can see this relatively easy in the chart formations and how a previous high or a previous low has been violated, and then a subsequent rejection and a retracement of a longer magnitude. But I want to teach you tonight a different approach to looking at distribution and accumulation. Okay, look at this pattern here. Okay, we're going to talk about a bearish rejection block. And before we get into it, the ideal setups are found in major to intermediate term downtrends. And the bearish rejection block is when a price high has formed with long wicks on the high or highs. It can be more than one candle that forms a high of the candlestick or sticks, and price reaches up above the body of the candle or candles to run the buy side liquidity out before the price declines. As you can see, there are several wicks here forming potential resistance. Now, a classic chartist would look at this as a potential continuation pattern in the form of a bull flag. We taught earlier in this mentorship the falsehoods that come along with some of the classical chart patterns. Price does not move around because of animal patterns or supposed geometry in price action. It's based on the orders. Okay, and looking at this price action here, if this is near a overall longer term resistance level or trading into a bearish order block or an old low that may not be seen in this sample size of data, but as you can see, prices ran up higher for a good number of candles. Then it starts moving into a small consolidation. But more importantly, I want you to look real close. Is there a strong likelihood that this is going to go higher based on a continuation pattern of like a bull flag or a pennant? Or is it showing underlying distribution? Notice there's no higher high here. Or is there? Take notice of the highest body in this formation and the most recent candle that traded through it. Price pushes above the previous highest candle's body. Seen right here, that run above the highest body's candle produces the distribution seen in the chart here. Price does not need to make a higher high to have a failure swing. By looking at the bodies of the candle, which is one of the first things I taught when I started teaching online how the foreign exchange market operates, you don't need to have a great deal of understanding about candlesticks except for understanding where the open, high, low, and close is. And if you follow every swing high and low, and you chart the open, high, low, and close, and you deal specifically with the opens and closes, you'll be able to ferret out what distribution and accumulation takes place at these turning points.